It's a real pleasure to introduce our keynote speaker, Nicholas Barberis, who is both an accomplished finance economist and a pioneer of the integration of psychological models in our understanding of individual and market behavior. Nick is the Stephen and Camille Schramm Professor of Finance at the Yale School of Management and a good friend to Caltech. His accomplishments are widely recognized among other honors, the Paul A. Samuelson Prize, the Fame Prize, and the Jack Trainer Prize. He is also a superb educator, recipient of multiple teaching awards at Yale and at the University of Chicago, where he previously taught. He organizes the Yale Summer School in Behavioral Finance and directs the NBR's working group in finance, following the footsteps of Nobel laureates Robert Shiller and Richard Thaler. His work in behavioral finance focuses on developing psychologically realistic models of market fluctuations and investor behavior. He also seeks to bridge the gap between rigorous academic finance research, like what we just heard, and actionable insights that inform investment behavior and market dynamics. It's an honor for us to have Nick Barberis present at Caltech Plus Finance, and I look forward to his insights into the rapidly evolving field of behavioral finance. What's going on in behavioral finance? A survey of the latest idea. Nick, thank you.
Thank you very much, Jean-Laurent. I'm very happy to be here for this day on Caltech and finance. I guess Caltech has a fairly small group, I might say, in finance and economics, and yet I find that it has really punched above its weight in terms of producing very innovative, interdisciplinary, high-quality, rigorous work, and I think it's well positioned to continue that trend in the future. So I'm very happy to be here for this occasion. I'm going to talk a little bit about behavioral finance, not for very long, and then I'll be very interested to hear your reactions, take your questions and comments. So a little bit of background first. I think many of you know that the modern research era in finance started in the 1950s, and from the 1950s to the 1990s, finance research was really dominated by a single framework, often called the rational agent framework, because it basically assumed that all market participants are fully rational. And it's a useful and important framework, but it's become clear that many important phenomena don't fit very easily into this framework. And so perhaps not surprisingly, starting in the 1990s, a second framework emerged, behavioral finance, which argues that many financial phenomena might be the result of less than fully rational thinking on the part of some market participants. And more broadly, it's advocating the use of models that are psychologically more realistic. Those of us in this field, we really feel that the models that finance has used for decades are just not psychologically realistic enough to capture important facts about the world. We need more psychologically realistic models. And when this field really got going about 25 years or so ago, it wasn't clear how it was going to do, but today I really feel confident saying to you that at least on some dimensions, behavioral finance has been successful. As I hope to show you, it explains observed facts in simple, intuitive ways. It makes testable predictions, at least some of which have been confirmed in the data. There's strong interest, not just among academics, but among practitioners and policymakers as well. Papers in this field are heavily cited, and the research has won a lot of prizes, not least Nobel Prizes to Richard Thaler, Robert Shiller, and Daniel Kahneman. That said, it still has quite a long way to go. For example, one goal is that all finance researchers be familiar with the core ideas in the field and apply them as appropriate. And currently that's not the case. So I think one task for those of us in behavioral finance is to convey the essential ideas in the field more broadly. And so I thought one thing I could do today is to try to do just that. So specifically, I thought today I could pick out 3 ideas from behavioral finance that seem to be really pretty useful: over-extrapolation of the past, overconfidence, and gain-loss utility with prospect theory. I'm going to try to show you that these 3 ideas, they can explain a number of central facts about asset prices, and after I've gone through that, I'll end with some broad thoughts about progress in the field. So first of all, over-extrapolation, it's really just the idea that when people form beliefs about the future, they put too much weight on the recent past. Today I'm going to focus specifically on the idea of extrapolation of returns. It's really just the idea if the recent returns on an asset or asset class have been good, people are too quick to think that the future returns will also be good. If the recent returns on an asset or asset class have been poor, people are too quick to think that the future returns will be poor. Now, this is an old idea in some ways. You can find it in qualitative, popular accounts of finance going back decades. The first wave of formal academic research in this area started in the 1990s, and just in the past 5 years there's been a second wave of research, and it's been spurred in part by renewed attention to survey data. So what do I mean by that? So there's actually a lot of surveys these days of both individual and institutional investors where we just ask them for their forecasts, for example, of future stock market returns. How do you think the market's going to do over the next year? And these data strongly suggest over-extrapolation of the past. So let me take that in two steps. First of all, these data point to extrapolation in the sense that if the stock market has recently done well, people think it's going to keep doing well. If the market has recently done poorly, people think it's going to keep doing poorly. And you can see that in this picture over on the bottom right here. This is the Gallup survey data in particular. It runs from about 1996 through 2012. And the red line is, in each quarter, we're asking people, how do you think the stock market's going to do over the next year? And the blue line is, at the very moment that we ask them, how had the stock market done over the previous year? And you can see a close link between the two lines. If the market had recently done well, people think it's going to keep doing well. If it had recently done poorly, people think it's going to keep doing poorly. But these data also suggest over-extrapolation. Why do we say that? Because if we compare people's stated expectations with how the market actually subsequently performs, you see a negative relationship, suggesting that people's expectations are not fully rational. And so these data, as I said, have spurred renewed interest in this idea of over-extrapolation of past returns. And one thing we've figured out over the past 5 years or so, doing mathematical models, is that models in which some investors extrapolate past returns can explain several of the most striking facts about asset prices. And I've picked out specifically momentum and reversals in the cross-section of asset returns, time series predictability in aggregate asset classes, and bubbles. And notice that these things, this is a large chunk of what we're trying to understand about asset prices. So the fact that a simple, intuitive idea can capture all of them is quite encouraging. So I want to convey the intuition for this, but just before I do that, let me just remind you what these facts are about. So first of all, momentum and reversals. So in the cross-section of stocks, but also in other asset classes, there's what is called medium-term momentum. So for example, stocks with high past 6-month returns have higher subsequent returns on average than stocks with low past 6-month returns. So perhaps to be a bit clearer about it, and think about it like this: take your database of thousands of stocks and at any moment in time rank all the stocks in your database based on how they've performed over the previous 6 months. So there'll be some big winner stocks and some big loser stocks. And you may be curious, how do these two groups of stocks perform later on? And what's been found in decades of US data, but also most international stock markets, is that these prior winners subsequently have a high average return, while the prior losers subsequently have a low average return. But there's also something called long-term reversals. Stocks with high past 3-year returns have lower subsequent returns on average, than stocks with low past 3-year returns. So again, probably a bit easier to see in a picture. Take your same database of stocks and this time rank the stocks based on their prior 3-year return. So you'll have some big winners and some big losers, and you may be curious, how do these two groups of stocks perform later on? And what's been found in decades of US data, but in most international markets as well, is that these long-term prior winners subsequently perform poorly on average, while the long-term prior losers subsequently perform quite well on average. And a long-standing challenge is to explain both of these facts in a parsimonious way. Another fact we're going to try to get at today is what I call time series predictability. Broadly, in aggregate asset classes, ratios of price to fundamentals predict subsequent returns with a negative sign. For example, in the overall stock market, the price to earnings ratio of the stock market predicts the market's subsequent return with a negative sign. You can see that in this picture. So every number in this graph is a year over the past century. The horizontal axis is the price to earnings ratio of the market in that year. And the vertical axis is the subsequent 10-year price growth of the stock market, roughly its subsequent return. And you can see a negative relationship. Years with high price to earnings ratios are followed by lower returns on average. Years with low price to earnings ratios are followed by higher returns on average. So in other words, the stock market is not a random walk. Its future return can be predicted at least a little bit in advance using, for example, this variable. And many economists feel like this is the most fundamental fact about the stock market that we need to understand. And finally, bubbles. These are episodes, as you well know, where the price of an asset rises dramatically and then collapses. And during the price rise, there's a lot of talk of possible overvaluation, as well as very high trading volume, as for example in the technology stock bubble of the late 1990s. And as I mentioned a few minutes ago, one thing we found by doing mathematical modeling over the past 5 years or so is that models where some investors extrapolate past returns can explain all of these facts. And some of this work is work that I've done with the previous speaker, but there's other work on this as well. So I wanted to convey to you the intuition for how do these models explain the 3 sets of facts I just talked about. So maybe we can do it with this picture. So in this picture, the blue line, the blue solid line, it plots for you the price path of an asset, of a risky asset, in an economy where some people extrapolate past returns, following some good news about the asset's fundamentals here at time 2. So why does the line look like that? Well, as soon as the good news about fundamentals comes out here at time 2, of course the price of the asset goes up. But what happens next? Now the return extrapolators look back, they see a high past return, that makes them think that the future return will be good, so they buy the asset, pushing it even further up. Here they look back and they see 2 periods of high returns. That gets them even more excited about the future, so they buy even more aggressively, pushing the price even further up. But at this point they look back and they see the recent returns have been positive but not as amazing as before. So while remaining enthusiastic, they become a little bit less so and the price starts to collapse. And now they look back and they see negative returns, so they get much less excited and the price comes down much further. And in that picture you can see all of the facts we were trying to explain. You can see momentum, right? Notice how the good past return is followed by another good return. The intuition is if an asset does well, extrapolators then think it's going to keep doing well, so they buy it, pushing it further up, at least in the short term. You can see the long-run reversals, right? Notice how the good long-term past return is followed by lower returns going forward. What's the intuition? The intuition is if an asset has a good long-term past return, that's an indication that it's become overvalued. In this case, by return extrapolators, the overvaluation corrects, bringing the low average returns. What about time series predictability? Well, it's around the peak of the blue line that the price is particularly high relative to earnings, and you can see it is indeed followed by low returns. Again, the intuition is that a high price to earnings ratio is an indication that the asset has become overvalued, in this case by people who over-extrapolate past return. The overvaluation corrects, bringing low returns. And finally, if the cash flow shocks at the start are especially large and there's a lot of return extrapolators in the economy, then the blue line will sort of be amplified. It'll be an even bigger price rise, an even bigger collapse, which is going to look a lot like a bubble. And this leads to one of the main behavioral finance models of bubbles, which is a bubble is triggered by good fundamental news that pushes up the price of an asset. That gets return extrapolators excited, who then buy the asset aggressively, pushing it even further up, at least in the short term. So all this is very encouraging, but I should also be upfront with you that it leaves a lot of questions unanswered. One basic question we haven't answered is, why do people extrapolate past returns when forming beliefs about future returns? We actually don't really know, but a number of ideas have been proposed, including some psychological mechanisms. One of them is that people might have an incorrect belief in a law of small numbers. So, as this crowd in particular will know, there is of course something called the law of large numbers, which is a true mathematical fact. It says that if you have a large data sample, then it's going to reflect the properties of the process that generated it. If you take a fair coin and you toss it 1,000,000 times, the ratio of heads to tails is very likely to be very close to 1. But Tversky and Kahneman had this beautiful idea that people might have an incorrect belief in a law of small numbers. They might incorrectly think that even a small data sample will reflect the properties of the process that generated it. And it turns out that can generate return extrapolation. The intuition would be something like this. If you see an asset post a few periods of high returns, well, someone with an incorrect belief in the law of small numbers is going to look at this and say, well, I see the high returns in this sample, but I think that even a small sample of data will reflect the properties of the underlying process. So the fact that this thing has high returns in sample tells me that its true mean return must be high, and therefore I forecast high returns into the future as well. In other words, I extrapolate returns. But still, we don't know. This remains an important open question. And actually, I think this is an issue that people at Caltech can help us with. There's a lot of expertise here in deep psychology, in neuroscience. So there may be ideas coming from that domain as to why exactly people extrapolate returns. More briefly, let me talk about two other ideas. First of all, overconfidence. So I want to distinguish two kinds of overconfidence. There's something called overplacement, which is people tend to have overly rosy views of their abilities relative to other people. It's most easily established in those surveys, right, where about 80% of people believe themselves to be above the median on various dimensions, like attractiveness, sense of humor, driving ability, ability to get along with people. Everyone thinks they're above the median, which is impossible. Many people must be deluding themselves. Second type is over-precision. People are too confident in the accuracy of their beliefs. And this is usually established through confidence intervals. So I could ask you a question, for example, how many gas stations are there in Connecticut? But I would ask not just for a point estimate, but also for a confidence interval so that you're 90% sure that the right answer falls into the confidence interval. So your guess might be 200, but your 90% interval might be from 100 to 300 in the sense that you're 90% sure that the right answer falls into that interval. And then I can ask you many such questions, and then I can see how often does the right answer fall into the intervals you've given me. If you're correctly calibrated, the right answer will fall into the intervals about 90% of the time. But decades of research has shown that the right answer falls into these intervals only about 50% of the time, indicating that these intervals are too narrow and suggesting that people are too confident in the precision of their initial estimate. So overconfidence has a number of important applications in finance. I just wanted to mention a couple to you. So one big motivation for thinking about overconfidence in finance is the very high trading volume we've observed in financial markets for decades. So non-speculative motives for trading like liquidity needs or rebalancing, these are unlikely to explain too much of it. Most trading is probably speculative, in other words, based on differing beliefs about an asset's future price change. Now, the key point here, which actually we really only understood in the 1980s, is it's hard to generate a lot of speculative trading in an economy where everyone is fully rational. And I've written here that that's because each investor infers others' information from prices or from their willingness to trade, which reduces her own willingness to trade. So let me simplify a little bit to explain what I mean. Suppose I go to buy a stock and you are willing to sell to me. If I'm fully rational, immediately I'm going to say, wait, why are you willing to sell to me? Okay, you might know something bad about the future prospects of this company. In which case, you know what, I think I'm not going to buy after all. That might sound extreme to you, but that is how a fully rational person will think. And indeed, when we write down mathematical models where everyone is fully rational, they don't generate a lot of trading, nothing like what we see in reality. And the point that has been made is that overconfidence is a nice way of breaking this logjam. Let me repeat the story now with some overconfidence. If I go to buy a stock and you are willing to sell to me, then I will say, why are you willing to sell to me? Oh, okay, so you think maybe you know something bad about the future prospects of this company. But then I say, I don't care what you think, because I think I'm much better than you at analyzing stocks, and you feel exactly the same about me, so we're both happy to trade. We both think we're on the winning side of the trade, although we can't both be. And indeed, when we write down mathematical models with overconfidence, we get much more trading volume, a bit closer to what we observe in reality. And the nice thing is that there's now empirical evidence to support the notion that overconfidence plays a role in trading volume. So if we wanted to test this hypothesis, here's a prediction we could test. If overconfidence is driving trading volume, then probably more overconfident people will trade more, because they're so sure they know what they're doing. And there's some nice tests of this idea. One that I find particularly compelling is this one by Grimblatt and Kelahaju. They use data from Finland. A number of these studies use data from Sweden or Finland. These countries keep very detailed records of what their citizens do. So it's a good place to run these studies. The challenge, of course, is to figure out who in Finland is more overconfident. So the way they do it is quite clever. It's like this. It turns out in Finland, at the age of 18 or 19, every Finnish man has to go into the army. And when you do so, you take a bunch of tests, some psychological tests and some aptitude tests, some tests of math and verbal ability. One of the psychological tests is a self-reported measure of confidence. How confident are you on a scale from 1 to 10? And so the measure of overconfidence in this study is your self-reported confidence minus how confident you should be based on your performance in the aptitude tests. So it's a bit cruel, but it's good, right? Your self-reported confidence minus how confident you should be. And the remarkable finding in this study is that that measure of overconfidence, measured at the age of 18 or 19, predicts the frequency with which you trade stocks several years later when you open a brokerage account of your own. And so it establishes this link between overconfidence and trading volume, supporting some of these behavioral theories. So I just want to note how to explain something as basic as trading volume, we may need to appeal to ideas from behavioral finance. Let me mention briefly one other application that may be of interest of overconfidence. Another application is to understanding acquisition activity. So a puzzle in finance for a long time is, why are there so many acquisitions? You may wonder what the puzzle is. The reason this is puzzling is there's little evidence that acquisitions create value for the acquiring firm on average. On average, the stock of the acquiring firm loses value over the 3 years after the event relative to a control group. So given that, why do we observe so many acquisitions? Well, there's a number of possible answers, but one intriguing answer is CEO overconfidence. So CEOs may know that the typical acquisition doesn't go very well, but he or she thinks that they're more talented than all of the other CEOs and that they can make their acquisition work even though the others can't. And actually Richard Roll, who's on the Caltech faculty, has some important early work on this, but many people actually associate this idea with Warren Buffett. You may have seen this classic paragraph from an annual report a long time ago. He wrote, "Many managements were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they're certain their managerial kiss will do wonders for the profitability of the target company. We've observed many kisses, but very few miracles. Nevertheless, many managerial princesses remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads." So he puts it very well, but we need to be scientific about this and we should test the hypothesis. So if overconfidence is driving acquisition activity, the natural prediction is more overconfident CEOs will do more acquisitions. The tricky part is, how do we figure out which CEOs are more overconfident? It's hard, but there is one influential study at least that sort of took a crack at this problem. Specifically, this study identified CEOs as overconfident if they held on to their executive stock options longer than recommended by standard models of option exercise. So many of you know, well, probably you all know that CEOs are often compensated with stock options, and there are models that guide them when they should exercise those options for optimal diversification and so on. And so these are CEOs who are holding on to the options longer than recommended. The idea is these are overconfident people who think they can grow their firm even more and that they will make more money exercising the options later. But we can check that they are overconfident rather than appropriately confident, because on average they lose money by exercising later than recommended. And the remarkable finding in this study is that these CEOs identified as overconfident indeed do more acquisitions, consistent with our prediction, particularly the most value-destroying acquisitions, so-called diversifying acquisitions, where you buy a firm in a different industry. Moreover, the market seems to understand what's going on. It reacts more negatively to acquisition announcements from these managers, as if to say, oh no, it's that crazily optimistic person again with their acquisition that's doomed to fail. And just in case you're not fully persuaded by that measure of overconfidence, the authors also did it another way. For each CEO they took all the newspaper articles that had been written about the CEO, and based on the adjectives that journalists used to describe the CEO, they categorized the CEO as either overconfident or not. So if the journalist was using words like optimistic or confident, they were categorized as more likely to be overconfident. If the journalist was using words like steady, reliable, frugal, conservative, they were categorized as less likely to be overconfident. And based on that, they reran all of their analyses and found similar results. And so this is quite striking, right? Because it suggests that psychological biases play a role even in these really high-stakes financial transactions where decisions are being made by seasoned executives. So it's really quite striking. And last thing I'll talk about a little more briefly, gain-loss utility with prospect theory. I'll expand a little bit on some of the issues that the previous speaker brought up. Up until now, I've been focused on people's beliefs. Let me turn now to what economists call preferences, which is given people's beliefs about future outcomes, how do they evaluate these outcomes? And this thing called prospect theory, due to Kahneman and Tversky, it's viewed by many psychologists as the best available answer to this question. So just repeating a few basic things, a few features of prospect theory. What it says is that when evaluating a risk, people think in terms of gains and losses. What could they gain? What could they lose? They're also loss averse, in other words, much more sensitive to potential losses than to gains. And another feature is this thing called probability weighting, the idea that people process probabilities in a non-linear way, in particular overweighting low probability outcomes. So let me show you a picture of that. So on the horizontal here is the objective probability of some outcome, and on the vertical is how much weight people put on an outcome with that probability when making a decision. The dashed 45-degree line is sort of the traditional answer to that question, a sort of linear answer. If you think something's going to happen with probability 0.3, then you put a weight of 0.3 on that outcome when making a decision. If you think something's going to happen with probability 0.7, then you put a weight of 0.7 on that outcome when making your decision. But Kahneman and Tversky, through their experiments, found that actually the weights people really use are different. They're given by this blue solid line. People use these non-linear weights. It's sort of a remarkable finding. I want to focus on the left-hand part of this picture over here, where you see what I just mentioned as overweighting low probability outcomes. And there's a lot of evidence for that. One piece of evidence is the fact that human beings like both lottery tickets and insurance policies. And that combination of behaviors is not easy to explain under traditional models, but it's nicely captured by this overweighting of low probability outcomes. The idea is when you're wondering whether to buy a lottery ticket, well, if the brain is overweighting the unlikely state of the world in which you win the jackpot, then you're going to want to buy the lottery ticket. And if when you're wondering whether to buy an insurance policy, the brain is overweighting the unlikely state of the world where you have a financial disaster, then you're going to want to buy the insurance policy too. And so while loss aversion is better known, a growing number of us think that it's actually probability weighting that has more applications in finance. I just wanted to sketch a couple of those for you. These applications hinge on the following prediction of probability weighting, which is that the skewness of an asset's returns will be priced, even idiosyncratic skewness. Positively skewed assets will be overpriced and have lower average returns. Negatively skewed assets will be underpriced and have high average returns. And let me be clear about the intuition there before I show you the applications. So remember that a positively skewed asset is one that offers you a small chance of a really good outcome. So it has a return distribution like this with a long right tail. Probability weighting is going to have its biggest impact over here. It's going to lead you to overweight these wonderful right tail outcomes. Therefore, you find this kind of asset very appealing. You pay a high price for it, and you're willing to accept a low average return. Negative skewed assets, as you remember, expose you to a small chance of a really bad outcome, so they have a return distribution like this with a long left tail, and so probability weighting has its primary impact over here in the left tail. It leads you to overweight these nasty left tail outcomes, as a result of which you dislike this asset, you pay a low price and require a high average return on it. And those simple predictions turn out to be very helpful for organizing a whole range of facts about asset prices. I'll just give you a couple of examples. They're very helpful for interpreting average returns on assets. So some average returns are puzzlingly high. For example, the average return on the overall stock market. Over the past century, the US stock market has outperformed T-bills by a very large margin, like 5 or 6% per year. Of course, we expect it to have a higher average return because it's riskier, but our models have had a hard time explaining the magnitude of the outperformance. Other average returns are surprisingly low. For example, the average returns of IPO stocks in the 5 years after the IPO are surprisingly low. From a classic early study of this phenomenon, the columns in the front row here, these are the returns of IPO stocks in the 5 years after the IPO, here averaged across thousands of historical IPOs. The columns in the back row are the returns of a control group of stocks, similar to the IPO stocks in terms of market cap or industry, but did their IPOs at other times. And you can see much lower average returns for the IPO stocks. So what explains all of this? All I want to point out is that probability weighting offers a simple interpretation of these findings. Why is that? Well, the overall stock market has negatively skewed returns. It looks like the lower of these two pictures because the overall stock market is subject to occasional large crashes. And probability weighting then immediately says, yes, this asset should have a high average return. The intuition is that when people thinking about the stock market as a whole, the brain is overweighting the low probability state of the world where there's a big market crash. Therefore, you find the stock market scary and you demand a high average return. Conversely, IPO stocks have positively skewed returns. They're like the upper of these two pictures. Most IPO stocks don't really go anywhere, but a small handful like Google or Microsoft have extraordinary right tail returns. But then probability weighting says, yes, such an asset should have a low average return. The intuition is that when you're thinking about a particular IPO, the brain is overweighting the unlikely state of the world where this turns out to be the next Google or Microsoft. As a result, you find this very exciting, you pay a high price and accept a low average return. And this idea that positively skewed assets should have low average returns, you see it all over the place. If you look at distressed stocks or bankrupt stocks that are still traded, or stocks traded off the main exchanges, or out of the money options on individual stocks, or stocks with high idiosyncratic volatility, all of these things have low average returns. Why is that? Well, one thing that's striking is that all of these things are also very positively skewed. So perhaps they have low average returns precisely because they're positively skewed. So I hope I've been able to convey to you these three ideas that seem to be particularly helpful for making sense of the data: over-extrapolation of the past, overconfidence, and aspects of prospect theory. And I've tried to sort of show you that they can be helpful for explaining a lot of central facts about markets, average returns, time series predictability, momentum and reversals, bubbles, trading volume. And I hope you'll agree they do so in simple and intuitive ways. And I hope you also got the sense that behavioral finance, it's not about little quirky curiosities. We're really trying to grapple with some of the basic facts in finance. Just a word on the future. For the past 25 years, conceptual progress in behavioral finance has really followed one approach, which was to take ideas in a particular sliver of psychology called judgment and decision-making, the area pioneered and dominated by Kahneman and Tversky, and incorporate those into finance. And I've tried to show you that has been fruitful, and it's continuing today in a vibrant way. But what we're certainly noticing is that people are beginning to move beyond this now. They're trying to incorporate ideas into finance from other areas of psychology, perhaps sort of deeper psychology in some sense, and from neuroscience, findings about memory, about attention, about efficient coding. The previous speaker, for example, has a paper on this. And this is one of the many ways in which I think Caltech is well positioned to do pioneering work in this area, because there is a lot of expertise at Caltech on deep psychology and neuroscience. So I think it's a very good place to be exploiting synergies between that knowledge and finance or economics. So, you know, back in the 1990s when behavioral finance got going, conferences often staged sort of debates between proponents of the rational side and proponents of the behavioral side. You may have seen some of those debates. I suppose they were fun and a bit entertaining, but I'm not sure how much they advanced the cause of science. And I think recognizing that, behavioral finance researchers sort of stopped the verbal debates and instead sort of focused on coming home, writing down careful models of their ideas, developing new predictions, and then testing these predictions. In other words, just acting like a normal science. And to the extent that behavioral finance has been successful, I think it's because of that approach. It's just acted like a normal science. And I expect it to continue doing that in the years ahead with, I hope, continued success. So I'll stop there, and with whatever time remains, I'll be glad to hear your reactions and comments and questions. I will just say that if you did want to dig a little bit deeper into any of the things I talked about, one place you could look is a review paper that I wrote last year that came out in the Handbook of Behavioral Economics. You might find some useful things there. Thank you. I'll stop there.